Considering you can sell your company and make 15 years of profit in one day or more, why would you not put some intention into that outcome? The best exits, the ones that are actually fun for the founder to go through, are reverse engineered and based on a very clear set of principles. To sell a business for maximum value, you've got to make it attractive from the outside and you've got to make it ready from the inside. When you put those two things together, that's when you get the highest points of the enterprise value. If you want to sell your business for 8 to 9 figures, you're crazy not to buy your competitors or buy products and services in another company and do that through acquisition, because it's by far the quickest way to build value, to scale. I can come on a show like this and talk about exiting for millions and all these big deals, and people get inspired and all of a sudden they want to do it. But there's so much self-reflection that you have before you go on that journey.
Today we're going to be talking about, the way you put it before you hit record was perfect. You said talking about the end of business in mind, as opposed to so often we're talking about startup phase or the beginning of business or just getting started in a business. But what happens at the end of a business when it's time to sell, or when a business owner wants to sell, but maybe they're not quite ready to do so, and there are things that they need to do in their business in order to scale and become sellable? So many things happen at this stage in business that we just don't know about. And that's why we have you here today. So we're going to be diving deep on that. But first, real quick, could you just give the listeners some context as to who you are? Tell us a little bit about your origin story and how you got to getting into entrepreneurship, but also 26 exits, $5 billion. Yeah. That's got to be a heck of a journey.
I'll try. It is a journey. God, it's not a straight line. It goes up and down.
Never linear.
No, I'll start off, I'll talk about the beginning and then I'll kind of accelerate through the middle a little bit. But I did start a business when I was 18 years of age, and I grew up in a place called Adelaide in South Australia. And we're talking now, I'm going to show my age, we're talking sort of the late 80s, early 90s. And the business was a personal training business. And people have, PTs all over the place now. It's a very common profession. But back then, no one had personal training. The only people who had a personal trainer were like really rich people. So I was doing this and I had this amazing network of wealthy clients. And then I did something really bizarre. I decided to kind of give that business up. I sold it to a mate. I sold really the client list to a mate for 3,000 Australian dollars, which is like a Starbucks coffee type of level. And I decided just to kind of go into the world of work. And it's interesting because this kind of comes back and kind of kicks me in the face a bit later. But I was influenced at that point in time by my family, and they weren't entrepreneurial. They were like, get a job is being safe. And so that's what I did. Even though my business was pretty successful, I just didn't have the confidence maybe at that point to continue on that journey, and I kind of gave up. But what was funny is I ended up going to Sydney from Adelaide, and because I had those wealthy clients and they were very connected, I ended up working for Rupert Murdoch in a big media company called News International. And it was there that I worked on all sorts of really great brands, learned about how to run businesses, how to scale businesses, learned a lot about marketing and branding, started to learn about mergers and acquisitions, because even in that world, there were a lot of acquisitions going on that Rupert Murdoch was doing. And that eventually led me to the UK, where I got headhunted to go and work for the second biggest media company in the UK, which was called EMAP. And I was promoted all the way through. So I'm in this kind of situation where I'm in the world of corporate. I'm doing quite well, but I'm a frustrated entrepreneur the whole way through because I keep getting kind of either promoted or fired. It's kind of weird. Like I'm getting to a certain level. I'm starting to be a little bit abrasive. I don't like being controlled, all the traits of an entrepreneur. And eventually it kind of got to a point where I was involved in it was a big exit of EMAP, which was one of the last biggest company sales before the financial crash in 2008. And it was broken up and sold into private equity. And then I left and I joined a company called Getty Images. And Getty Images was a private equity backed company and grew by buying other companies. So all of a sudden, I'd gone from being an entrepreneur to being in corporate, learning, lots of skills around how to run businesses, then going into private equity and getting taught a whole different game. I remember there was a guy who was the founder of Getty, a guy called Jonathan Klein, and he said, everything that you've learned about growth and scale, that's not how we do it here. We buy companies. And when I was there, I was involved in about 30 acquisitions and deals and worked in private equity. And then I got the bug for it. So I ended up staying in that world of private equity. We can define what that is for listeners if people don't know. And I got to run companies as a CEO. I did that 4 times. And then I started getting a reputation for going into companies that are invested in by these private equity firms and turning them around and scaling them. And I did that all the way up until 2018, where I decided to leave. So I'll pause there because I told you it's a long story. Okay. But a huge, amazing lot of experiences, all the way through that sort of first part of my career.
Wow. Okay. So yeah, just in case anybody listening out there is not perfectly familiar with PE, private equity, give us the proper definition for that.
Yeah, so private equity is effectively, it's often defined as a fund, but it's not really just that. It's where money is raised from high net worth individuals and institutions. Sometimes it's pension funds and things like that. And that money is raised by a private equity firm that's run by a number of partners. And the whole mandate of a private equity firm is to invest that capital into buying companies, bolting them together to create bigger groups of companies, and then sell those groups for significantly more money, usually within a 3 to 7 year period. And the amount of growth that happens in those private equity firms, in my opinion, dwarfs a lot of what founders ever achieve. Because there's a certain way that private equity firms grow and scale companies that is just different. And that I was very privileged to learn those skills, I suppose, and those experiences when I was in those companies I mentioned.
Yeah, and PE is huge in the States with, especially in the service sector, like home service companies being bought up by private equity and a lot of mom and pop shops. You know, there's 10,000 boomers are retiring a day and half of them own a business, like something crazy like that. True. So there's a lot of opportunity.
Big wealth transfer, as it's called. And it's true. It is true. Yes. But the other statistic, though, is that only 2 out of 10 companies ever sell. So the question to be asking here is, well, there's all this money, there's all these private equity firms, there's all these baby boomers retiring, but only 2 out of any 10 companies sell. So what's happening there? And that, I mean, we can cover that today because I think there is a point where you can reverse those odds and you can get like an 80% chance of selling if your business is built the right way.
Yeah, so let's dive in right there. And this is going to coincide with where your story picked up in 2018, where you went out on your own.
Yeah.
So let's smash the two together and talk about why there's such a discrepancy between so much opportunity, yet so much of it seemingly missed, where you said only 2 out of 10 of these companies actually sell. So tell us why that is.
So let me tell you the transition into what I do now, and then I'll answer the question. So around 2018, I was involved in a really big exit. And it was a $2.3 billion exit of a company. It was owned by one private equity firm being sold to another one. In fact, the business or the private equity firm that bought that company is called Blackstone, and they are the biggest PE firm in the world. Now,
ever heard of them?
Some people have, some people haven't. I was the CEO of the international division of that company. So there's a group CEO and I ran a division. It was a really horrific experience in terms of I had a lot of personal things going on. My dad was dying of cancer at the time. The deal was going back. Lots of things were going on. And I had this almost like a breakdown. I literally went to bed one night and I crushed the 2 molars in the right side of my jaw. And I woke up at about 3 a.m. and my face was like swollen, like I'd been smashed in the face, literally. And I ended up going to the mirror and seeing I didn't know if I'd been bitten by something. It was like that. Anyway, I ended up going to the dentist the next day and they said that you've literally cracked your teeth based on stress. And it was because this deal was really, really full on. It wasn't getting much sleep. Things weren't going well. So I wasn't certainly going to benefit really that much from what was going on. My dad was dying. And I ended up going to a Tony Robbins event, of all things. A friend of mine suggested I should just get yourself in a different room. So I went to this event in Chicago and I was in there for 4 days. And it was in that experience that I decided to leave private equity and start my own podcast. And then the whole premise behind that was I want to jump on the other side of the table and I want to make sure that I can level the playing field for founders so that when they get to the point where they could potentially sell their companies for millions, they're not going to get taken advantage of by private equity, which can be a very ruthless and cutthroat part of the world. So I share that part because now, so the last 7 years, that's all I've done. So I'm still involved in private equity in terms of I have to be because I'm helping people, exit their companies. But I now work exclusively with founders and business owners.
Wow. Okay. So you were on the other side of the table at PE. Did you say you were at Blackstone?
Yeah, for a little while after the business was sold. But but I've been involved. I've been working in the private equity firms. It's called an operating partner. It's where when private equity buys a company, they normally put a team around that company to make sure that the investment grows and scales. And an operating partner is there to mentor the founder and make sure that they can, if I'm honest with you, make sure that they can work in that private equity environment successfully, and if they can't, they're gone.
Yeah.
Right.
They get removed.
So that's what I was doing. And I just thought, you know what, I want to do that on the other side. And now I specialize, I suppose, in teaching all the things that I learned in that almost 12 years in private equity, I teach those things to founders, particularly the ones that are trying to achieve an 8 to 9 figure exit.
I love this because, and you know from being on the other side of the table, and you said, PE does a fantastic job of getting everything they want, right? And when there's founders or business owners that are looking to sell and they're a prime target and they've never done it before, there's not a ton of business owners who have done multiple exits, right?
It's
Like
very
everybody
rare.
has their first one, and oftentimes it'll be their only one. So it's going to be very easy to be taken advantage of because you just don't know what you don't know. So I love that you are now on the other side of the table supporting these founders to get their max due, right? And not get taken advantage of. So let's dive in there and talk about the things that you do to help these founders avoid the pitfalls of selling to private equity and making sure that their businesses are in fact sellable for the highest possible number.
Yeah. So the key thing is, and I think this is something that I would just want to educate business owners on, is lots of people just think about growth and scale, and they don't really have an idea about what that end game looks like. And, it makes sense because you're 100% right. Like it can be a one and done thing if you sell a business for lots of money and, it can change your life, right? So, you're in a situation where you're not really focused on being good at exiting. You're focused on being good at entrepreneurship, the growth part. So what I say to people is, yeah, that's all great, but considering you can sell your company and make, 15 years of profit in one day or more, right? Why would you not put some intention into that outcome? So this idea that I'm just going to, one day someone's going to rock up and buy my business because I built a great business, that doesn't really happen. It does happen on certain occasions, but the best exits, the big exits, the ones that are actually fun for the founder to go through are reverse engineered. They're fully designed, they're constructed, and they're based on a very clear set of principles. And so I'll break those down for people. And some of this is in my book as well. It's under a methodology I called Scale to Sale. But there are 5 key bits. The first bit is, I call it clear end game. And very simply, it is reverse engineering from an outcome. It's the whole begin with the end in mind thing, right? And it's obvious when you think about it. But in private equity, when a private equity firm buys a company, the first thing they do on day one is plan the exit, even though it's 3 to 7 years away. So I say to anyone I work with, clients I work with, I say, let's get really clear on the outcome. Let's work back from a 3-year vision. And, even if you want to sell the business in 3 to 5 years, let's get really intentional about what that business needs to look like. Really, really clear for you to be able to kind of, have the option of potentially selling it. Okay, so that's the first thing. Second thing is making sure that you strengthen the foundations of the business. Everyone wants to scale, Brien. They kind of want to do the cool, fun stuff. And a lot of people these days want to do acquisitions. It's the sexy thing. But you can't buy other companies and bolt them onto something that's crap, right? And crap's an interesting word. But what I mean by that is, there's too much dependence on the owner. If one client leaves, all of a sudden 25% of your revenue's gone. You've got people running around the place not knowing what they should be doing because nothing's documented and the culture's bad, right? So people try and jump to scale too quickly, particularly if they're going from startup into a scale stage business, when they have to actually de-risk their business first. And the best way to define it is, if you buy a house and you want to extend that house or put a loft conversion on it, you want to make sure the thing's not going to break under that stress and strain. And that's what the second pillar is. Makes sense when you think about it. But again, a lot of entrepreneurs that I work with don't think like that.
Yeah, well, it's like you can't build a house on a sand foundation, right? You got to have a slab in place.
You got to have that
a solid foundation.
Exactly. So after you've done that, the third pillar is, I call it scale fast and build value. But the playbook of private equity is acquisitions. You don't have to do that. I mean, there's organic growth, there's strategic partnerships. But if you've got a business that's growing from sort of 7 figures of revenue to suddenly 7 figures of profit, you're crazy. If you want to sell your business for 8 to 9 figures, you're crazy not to start to look to buy your competitors or buy products and services in another company and do that through acquisition, because it's by far and away the quickest way to build value, to scale. And it's actually quite easy to do once you learn how to do it. But like any new skill, it's intimidating for a lot of people and they have to kind of, go through that education. So that's that. And then once you've got the business to a certain level where you think, you know what, we're ready now, it's going to hit my target. I know what my end game number is. I know the valuation. We go into a stage which I call prepare and profit up. And that's not really about taking cost out, even though it talks about the profitability. It's like doing due diligence on your business, like assessing and auditing your business before you're going to start a sales process. And we do that with clients because we want to make sure that whatever that number is that they want to achieve in the clear end game, the first pillar of scale to say, we want to make sure that there's absolute certainty they're going to get that number or more. And so that part of the process can take at least 6 months because you're not going to put the business on the market until you're sure of that. Now here, right. I'll say most business owners don't even do any of that. And they go, I'm just going to put business on the market. I'm going to hire a broker or an investment banker. And then they're surprised why their business either didn't sell or it sold for something less than what they expected because they haven't put this level of work and understanding that we're talking about now into it. So that's the 4. The 5th one, and I won't go into this in too much detail, is the sales process. And there's a whole way that you run the sales process that I advise differently than most people do, where you get to control that and choose your acquirer. And that to me is a very powerful position to be in, particularly when there's so much riding on that outcome.
All right. So when you're working with a founder to start designing their business with the end in mind, yep. What are, I guess, in terms of, the things that you notice that are lacking most? Is it related to systems and processes, or is there just a complete misunderstanding of how to even make your business sellable? Because it's one thing to have assets and to have customers, but it's another thing to be attractive to someone to buy you. So what does that look like? Does it all come back to systems and processes? I feel like that plays a
part
role
of it,
in
but
somewhere.
that's only, there's 15 different factors, and that's one of them. So There's a thing called transfer value. And the best way to think of this, and particularly in private equity, so it does change a little bit, excuse me, if a company buys you, but in private equity, we want to buy a well-oiled machine. And what does that really look like? Well, we look at it through both the lens of risk and upside. So that strengthening foundation piece about removing risks is the key part, because that's what a PE firm would do. Equally, we want to buy what the business can become. So transfer value is, is there anything in the business that's going to compromise its predictability, its scalability into the future, right? Is there anything that's going to stop that? So does it have a really good growth story coming into this potential sale? Is the business, as we mentioned before, over-reliant on the founder? Is there a key person that could be the founder or not, that if that person is now no longer motivated, because I'm going to give them literally a truckload of cash, they're going to go. And if I haven't got a mitigation, a succession plan around that individual or, a couple of individuals, I'm going to devalue the business. Then you've got, acquisition channels, like how does the business drive leads and grow? So what's its growth engine look like? Am I reliant on Facebook ads? Am I reliant on LinkedIn? Am I reliant on referrals? Have I got a machine in place which drives that growth? Then you've got kind of the financials themselves. Can I actually make sense of them? Because I've been involved in businesses, Brien, where the business looks like it's making a lot of money. The founder thinks it's making a lot of money. And then you get into the financials, they're not audited or anything like that. And the business is making half because they're just looking at the cash flow, but they're not looking at the liabilities. And there's all these tax liabilities that no one's thought about. And all of a sudden the business is worth a quarter of what someone thought it was before that happened. So there's lots of things that need to be fixed and thought about. And probably the most important thing is that you have, I call it like an exit vision, or it's kind of the baton pass, if you understand the expression of what you've created to a new owner. You want to make that vision for the future so compelling that even though you might be exiting your business, the business isn't stopping. You're really giving it to someone else who has different resources, networks, maybe a different strategy to be able to expand it. And the more that you can, package and prepare your business around some of those things I said, it's going to do 2 things. Firstly, it's going to open up the buyer marketplace, which is an important characteristic. And it's also going to increase the multiple, and it's the multiple times by the net profit, the EBITDA, which is the valuation. And the more that you can flex those things, the higher the number is that you're going to get.
Got it. All right. So what are, I guess you've mentioned a few of them, what are the biggest things that compromise a business when it comes to wanting to be acquired by PE?
Yeah, a few of them I've mentioned. I think the big one is definitely a business that's going backwards. Firstly, a business that's not profitable is not really that attractive at all. So private equity don't buy startups that are not profitable, right? They might sometimes invest, but generally speaking, we want to buy profitable cash flowing businesses. That's why you mentioned about service businesses. They're great because they're quite simple business models and they cash flow. And then you can put other businesses like that together and you can get a compounding effect. So they want to buy businesses that are growing, that are profitable, that aren't overly complex, and that that have leadership teams in place, that have already got the, I say platform, but they have the ability to scale through acquisition. So the foundations are already fixed. They have a really well-defined brand that is usually a market leader, or certainly number one or two in their defined market. They have a culture that's driving performance. Because again, remember, if the founder leaves with a truckload of cash, the culture is what defines how the business keeps performing. If there's intellectual property, which also adds value, that's well protected. And you mentioned systems and processes. Yeah, systems and processes are important because, again, it just de-risks any of the people risk. So you want everyone to know their role in the company aligned to the strategy. So that all has to be locked down. And then you've got the idea that everyone kind of works in unison. So the best way to describe it, we talk about it in two different ways. We talk about it in terms of business attractiveness and exit readiness. So business attractiveness is what your business looks like from the outside in. And I like to think about cars. Like if you see a beautiful Ferrari, that the paintwork's pristine, it's bright red, but the engine doesn't start, that's business attractiveness. It's attractive until you kind of get the thing working, right? And then it's not.
Right.
Exit readiness, though, is the opposite. The car, the same Ferrari might be all beaten up and dented, but when you start it, it's amazing. It sounds brilliant. The engine is tuned. It's perfect. Of course, you've got to do some things to it, but it's ready to go. So to sell a business for maximum value, you've got to make it attractive from the outside, and you've got to make it ready from the inside. And when you put those two things together, that's when you hit the highest points of the enterprise value.
At what stage do you work with most of your clients at? Are they at the stage of, hey, I think I want to sell, but I don't even know if I'm sellable? Or are they like, hey, we're about ready to get to the table?
Three different ways. I work with founders at scale stage without even talking about exiting. So we have a group where we just talk about the principles of scale, which is pipeline, process, and profit. So, predictability of revenue, processes so that the business can run without you, and then profit, the business compounds its EBITDA into cash. So if you want to ever have the chance of selling your company one day, you've got to master those areas, really. And then once someone has, started to scale properly, because these are the principles of scale, we then need to focus on how we increase the value. So again, if a business is scaling, the business is working independently well, we can then start to look at things like acquisition. So I have the group, and then I work one-to-one with businesses. Once they go from 7 figures of revenue to 7 figures of net profit, they can then work with me one-to-one. And I normally join their boards, and I advise and mentor the founders on how to build significant amounts of enterprise value. That process can take 3 to 5 years, depending on what they're going for. I have a lot of people come to me wanting to do a 9-figure exit. They've got this goal that they want to take their business to 100 million. And in order to do that, you've got to get your profits, your EBITDA up generally over 10 million, depends on the industry. So if they've started with me at 1 million or 2 million and they want to get to 10, we need to find 8 million of EBITDA. So I work with them to do that. And then if a business is within, say, 24 months of an actual sale, like they think they're ready, to your question, they're ready to go, we will assess the business to see if that's true, and we'll fix things up and we'll make sure that's the case. If they're not ready and they're miles off, they can come back and work with us with the other programs. Quite often at the point where we assess them for a sale, they're usually pretty good at that stage. The founder kind of knows what's going on, and they want to bring us in almost like an insurance policy to make sure that they're going to get the outcome before they start, that sales process.
Can we go down a quick rabbit hole? A couple of times you've mentioned EBITDA before. I think there's plenty of folks out there who might not be perfectly familiar with EBITDA, but also the importance of the profitability of the business. So many people think top line is the only thing that matters, and that couldn't be farther from the truth. So I want to set you loose on a rabbit hole as it pertains to EBITDA and profitability, as it pertains to being attractive to sell.
Yeah, so EBITDA, the best way to describe it stands for earnings before interest, tax, depreciation, amortization. So that's the EBITDA, right? The best way to say it, though, it's net profit, right? So you've got gross profit and you've got net profit. And gross profit, most people think, I've got a gross margin of this, but they're not taking into account their operational expenses. They're looking at the cost of goods sold, how they sell. So when you look at your net profit, you're taking into account both the operating costs of the business as well as the cost it takes to actually sell your products and services. And so when we're looking at evaluation, it all comes back to cash flow. Business's ability to cash flow at a scale and at a pace, at rapid, defines a lot of where the value sits. So the most important thing to think about if you've got a business is, how quickly does my business convert revenue to cash? Okay, because cash is king, and cash you can invest, and sometimes you can make profit, but you don't really have the liquidity. And we want businesses that can really just print money, right? That's the whole game. Okay, and the reason that's important is in private equity, when they buy companies, they do use a lot of debt, so they want to be able to pay back that debt, and so they need to be able to get that, that money from somewhere as well. So hopefully that helps demystify it. I think it is the language of an exit. So if you do have the intention one day of wanting to sell your business for 8 or 9 figures, you're going to have to learn this stuff. It's not difficult, but if you're negotiating with someone like me, like I used to be, and you made the point, like it's a one and done thing for most entrepreneurs, I'm buying a business or selling a business every week. So like for you to be able to have a conversation with me and be credible and to be able to compete in the game that I'm playing, you have to learn this stuff.
Well, and it just speaks to you need to know your numbers as a founder. It's the founder, the CFO, the bookkeeper, whoever it is. These are the people that need to have the best handle on the numbers, or else you're going to be, it's like sailing blind, right? So I think if anything, make sure you're checking your numbers and checking your profitability. Check the net, please. Like do yourself a favor.
I mean,
as a
metrics
is,
because, this is just great business practice, right? You've got to know all of that stuff, right? That's why when businesses get to a certain level, I always try and put in fractional CFOs, chief financial officers in, just because you need someone else who you need to know your numbers, but you also need someone who's really good at being able to give you the numbers, right? And quite a lot of founders still try and do everything themselves. And all of those things make it very, very difficult for someone like me, to come in and assess the business and go, well, I need to look at risk and upside. And the easier you can make it for me to understand those things, the more value I'm going to attribute to your company.
So what are the types of businesses that you work with? Is it all full spectrum?
Yeah, I've basically tried to model as best I can the private equity playbook for founder-led businesses. So there's no industry. I mean, I love service businesses. I love service businesses because I think they're very easy to scale. And that can be things like even like home services, but professional services businesses, agencies, consultancies, law firms, that sort of stuff can be really good. Where it gets really tricky is when you get like SaaS businesses that aren't profitable, because they're investing so much money into technology. Retail businesses can be quite tricky because, again, they're very capital intensive. If you've got a product that needs to be sold in Walmart or Target, you've got to have a lot of capital to be able to just make the product and put it on the shelves. It doesn't mean that we wouldn't get involved in the planning and the strategy around those, but we like businesses that are profitable and we can do really cool things to make them more profitable. But it's not really specific to an industry. It's more of a stage, I call it scale stage, of where that business is at.
Got it. Okay. So service-based businesses are kind of the prime area. So you mentioned that the clients that work with you, you essentially become a board member in their business.
Yep.
Help us understand kind of the things you do more hands-on with a founder. Are you getting in there and getting your hands dirty and saying, hey, this is how we need to do things. You're doing it this way, but if you want to get to, another 3 million in EBITDA, these 3 things or whatever that number is need to happen, and here's how it's going to happen? Or is it more directed where you're saying, this is what you need to do, go get it done? How does that operate?
It's more the latter, but it's not exclusively the latter. So let me unpack what happens if you sell a company to private equity. So I mentioned beforehand, I was an operating partner as well as a CEO under investor backing. And if you're acquired, there's a thing called a platform acquisition. So a platform acquisition is the first acquisition that a private equity firm makes in a given market. So let's say they buy a roofing business and the intention is to go and buy, plumbing and solar businesses and bolt them all together to create a home services group. The first acquisition, that roofing business, would be called the platform. In that situation, there's a lot of assessment that goes on before the deal is done, or the due diligence and things like that, where they're auditing the company. But they'll still put what is called an operating partner over that business. And that person, as I said, is there to mentor the founder. And because they're usually someone who has exited a company before, they've done what the intention is with this business. They're pretty wise and they're pretty experienced on all the different scenarios of what running a business means. Leadership, operations, marketing, sales, all of those areas. So what I specifically do is I bring that operating partner thesis and method to founders. So I'm joining to advise and mentor them. I'm, telling them where they're going wrong. A lot of the time I'm holding them accountable. Sometimes the founders that I work with find this really challenging But remember, if the goal is to sell your company to someone like that, you're better to get used to it with someone that you're bringing in, because it's also educating you and getting you used to that environment. But I will also bring in resources where there are gaps. So if we need growth, I actually own a marketing agency where we can bring that in and we can drive growth. I've got fractional CFOs that I can bring into any situation to fix finances. If we need to recruit, I've got really good HR professionals and headhunters. So when I work with someone, they get me as their main sort of strategic advisor and mentor, helping them, build to that end game. But if there are gaps, I help them fill the gaps. I don't go in operationally and become the COO or anything like that. I'm sitting above the business, calling out the things that may be blind spots for that founder that's going to stop them getting to the goal that they want to get to.
Do you find pushback from clients on some of the methodology that you're bringing in? Or I imagine if they're contracting with you, it's like, hey, you're the expert. I trust you. We're going to do what you say.
Yeah, I position myself as the partner they know they need, but they haven't got. And so, there are arguments, and there are calls on weekends at times where someone's flipping out and they just need me to kind of calm them down. That happens a lot. You'd be surprised how many of the conversations are mindset related versus strategies and tactics, right?
I bet.
How are you showing up? A lot of it is leadership, and that. Because what I think is interesting is these people, remember, some of them have been really good startup founders. And now suddenly they're dealing with the complexity of scale. They've got more people around them than they ever wanted. They've got technology that they don't understand. They're starting to work with processes that feel stifling. But they also realize that if they don't get comfortable with those things, they're not going to be able to build the business to a level where they could achieve their outcome. So I'm getting them, I'm actually working on their identity as a leader as much as I am helping them and grow the business. So yeah, we have arguments, we have fights, but it comes from the right place. And I'm really clear with people, if we don't get on, if the relationship isn't there, particularly with my one-to-one clients, where I often get equity in their businesses too, I'm a partner, I'm just as incentivized as them to get to the outcome, right? They're going to make a much bigger piece of the pie than me, but either way, I'm still getting, remunerated for the value. I'm not here to muck around. And sometimes it's got to a position where if someone isn't open to mentoring or coaching or that perspective, it's just not the right fit. So, we'd part ways in that way. But it's definitely not a consultancy type of thing. It's definitely more of a partnership thing.
Love it. How many clients do you work with at any given time?
So one-to-one, in our group, we have a maximum of 100 in the group. And I'll talk a little bit about that because it's quite interesting. But in my kind of private advisory, maximum of 10. And then anyone who wants to kind of learn more about their business from an exit perspective, we have a product called the High Value Exit Accelerator that I have a team who delivers that. So that's like an exit strategy consult. That takes 30 days. So I'm involved in that, but I have really good people in there doing all the assessments and stuff, and I just get involved in pulling that together. So that's unlimited. We can do as many of those as need be. But my private clients where I'm embedded, I'm about to jump on a plane to Miami to go and do a retreat with one of them, and I've been working with this guy for 3 years. This year alone, we added another $1 million of EBITDA to their business just on the different strategies that we've been adopting. So It's that level of, it is hands-on. It was a great question, but it's not on the tools. It's hands-on in terms of I know everything that's going on in these businesses because I'm an equity holder quite often, or certainly, as I said, invested in the outcome as much as they are.
Yeah. It's almost, the show Shark Tank where people come, they're looking for an investment, but the majority of them, it's not necessarily about the money. It's that they need a partner.
That's right.
They need someone who knows the ropes, who can get them into the Walmarts or get them into XYZ. 100%. It's all about the network and the resources.
It is. It's network, it's strategy, it's experience. Sometimes it's funding, right? Depending. Like I do help people raise money and whatever else. I very rarely put my own money into the partner clients because it changes the relationship a little bit. And also they're effectively buying my expertise through equity and retainers or whatever that deal looks like. But it's a really powerful thing for the right type of founder, again, who's going for a big outcome. This is not about building a lifestyle business. There's no point having me around. This is about, I'm about to go into uncharted waters. I could get screwed. I have no idea how private equity firms operate. I know it's a game and I want to be as good at the game to be able to win. It's that type of, situation.
Right. It's like, Tom Brady always had the best coaches, right?
Yep.
And he's the greatest quarterback of all time. It's, there's for every Brady, there's a Belichick. And it's no different for business owners who want to scale and to sell. you need someone on your team who's been there and can coach you through it, or, literally have skin in the game to help you get to the end goal.
Exactly. And I love it too. I become very good friends. I mean, some of the my partners, as I call them, I've worked with for, as I said, multiple years. We go to golf days together. I've been around to their house. We have a lot of fun because it doesn't feel like anything other than a partnership with a really clear goal.
Yeah, absolutely. I love it. Well, so as we round out here, I guess kind of my final question, what's the question that I'm not asking you that I should ask, or the question that you wish more people would ask you about the work that you do?
Okay, so the one that comes to mind, there's probably plenty. The one that comes to mind is, should everyone scale their business? And a little bit of a framing of that. So when I launched my podcast back in 2019, it was called Scale Up Your Business. It's now called Scale Up with Nick Bradley. But it was the first real podcast talking about scaling. And it's still, by every measure, if you search scaling podcasts, it's number one globally. But here's the little trick, or here's the kind of hidden thing. Not everyone should. And the journey from a really great business that supports your lifestyle, makes you great money, gives you freedom, gives you flexibility, that's a great thing for the right person. And for you to build a business that's, I call it a performance business, but a business that's at scale stage, there's so many sacrifices that you have to make, usually for a bigger outcome in the future. And I just don't think everyone should do that. You've got to be really honest about who you are and what your goals are. And I can come on a show like this and talk about exiting for millions and all these big deals, and people get inspired and all of a sudden they want to do it. But there's so much self-reflection that you have before you go on that journey. For the people who want to take that on, absolutely, it's great, but don't think it's easy.
All right. Perfect advice. Sage advice there. I like that. All right. Well, Nick, this has been awesome. Thank you so much for joining us. You're a busy man. This is like your 18th podcast today, so I got to let you go.
Sir. I'm going to go have some food now.
We could keep going. Yeah. You're hungry. You need a glass of wine. It's that time of day out in the UK. So I'll let you get going here. But first, before I do, I want to make sure that anybody out there listening, if they want to either work with you, learn from you, check out your book, check out your podcast, what are the best places to do all that?
Yeah, so my book, which I've been talking a little bit about today, is Exit for Millions, the private equity blueprint for scaling and selling your business for maximum value. Amazon, go there. It's launched 2 weeks ago. It's doing really, really well. It's getting great feedback. And a lot of the stuff that we've covered today is in the book, which is cool. My podcast, Scale Up with Nick Bradley, wherever you listen to podcasts, Spotify, Apple, whatever. It's been number one business podcast in the UK. We've done, I think, 1.5 million downloads, something like that, across many countries. It's got everything around scaling that I learned through PE through those episodes. And a lot of them are me talking to the mic, so super practical stuff as well. And then for me personally, LinkedIn. So my LinkedIn handle is Real Nick Bradley. You'll find me there. Send me a DM if you like the conversation here. If you need some help with your business, reach out as well. Always happy to have that conversation.
Awesome. Well, guys, go buy his book, check out the podcast, reach out to him on LinkedIn. Nick, this has been an absolute pleasure, and thank you so much for stopping by and sharing your knowledge today.
Well, thank you, Brien. It's been great.